What if your mortgage could work more like a checking account, where every dollar you deposit instantly reduces your balance and the interest you pay? That's exactly what a first lien HELOC does, and it could save you tens of thousands of dollars compared to a traditional mortgage. A first lien HELOC is a home equity line of credit that replaces your primary mortgage as the first loan on your property. Unlike a traditional mortgage where you get a lump sum and pay it back over 30 years, with most of your early payments going straight to interest, a first lien HELOC calculates interest based on your average daily balance. That means every time your paycheck, rental income, or any deposit hits your account, your balance drops and so does the interest you owe. Here's what that looks like in practice. On a traditional $200,000 mortgage at 4.5%, you'll pay nearly $165,000 in total interest over 30 years. With a first lien HELOC using the same rate, a borrower with consistent income and disciplined spending could pay that same loan off in under 6 years with total interest under $28,000. That's over $135,000 in savings. And a first lien HELOC gives you something a traditional mortgage never will: revolving access to your equity. During the draw period, you can borrow, repay, and borrow again as needed. Home renovation, unexpected expense, investment opportunity. Your equity is available without refinancing or applying for a new loan. Now here's something most people don't realize. If your loan amount is below $150,000, most traditional mortgage lenders won't even take your call. Thanks to Dodd-Frank regulations, the compliance costs and legal requirements on a traditional mortgage are so high that lenders can't make enough on a small loan to justify the file. You're not being turned down because of your credit. You're being turned down because the math doesn't work for the lender. A first lien HELOC solves that problem entirely. There's no minimum loan amount issue, no profitability gap, and no regulatory hurdle standing between you and your funding. This is also why more seniors are choosing a first lien HELOC over a reverse mortgage. If you own your home free and clear and want to access your equity, a reverse mortgage is one option, but it comes with FHA insurance premiums, origination fees, and a loan balance that grows over time. Where a first lien HELOC gives you access to the same equity with interest-only payments, no FHA costs, and full control over how much you borrow and when you pay it back. For seniors who want flexibility without the long-term commitment of a reverse mortgage, a first lien HELOC is the smarter play. At Trust Financial Group, we help homeowners, investors, and seniors determine whether a first lien HELOC is the right fit, and if it is, we'll get you the best rate and terms available. Whether you're replacing an existing mortgage, accessing equity on a paid-off home, or solving the small loan amount problem, we've got a solution. Ready to find out if a first lien HELOC is right for you? Click below to connect with a trust loan officer. Flexible access, lower interest costs. Your mortgage, working the way it should.